Welcome back, everyone, to Living Your Greatness. And I'm joined today again with Michael Oliver. And I want to start off before I welcome Michael Oliver just to say Happy New Year and so good to see you.
Good to be back, Ben.
Always good to see you, Michael. And it's just crazy to look back that the last time we spoke, silver was at $50, gold was at 4,100. And it's less about the price because even though today now we see silver about at $78 and gold at just shy of 4,500, I'm more concerned right now of things coming to truth and coming to light. And I would love to get your opinion on what was it that happened back when we last spoke and where we are today and where you see things going? Because I know both yourself as well as Eric Sprott, who really appreciates your work. I know you both believe that in the next 2 quarters, there's going to be a lot of change for the precious metal space.
Yeah, particularly silver. We've done a lot of studies in MSA, momentum structural analysis, using our own unorthodox methodology. But again, we've been around since 92. Okay. But what's going on in silver now is not normal, and don't expect it to be normal. Most technical analysts, when they analyze any given market, they look back through the last couple of years in that market and they see norms like, oh, excessive overbought, oversold, uh, swing objectives, things like that. And they're still living in that world with silver. And I think they're making a big mistake. Silver as a money, remember, don't forget it's money. It's not just silver's like surfing on a wave, but it's really on two waves. The one that's the big one is the monetary aspect of silver and gold. That's the major differentiating asset value underlying those metals. But silver also has the industrial aspect, which is exploding because we know demand for silver in a couple high-tech categories, and all the data centers and computers and solar panels and so forth and so on. It's in demand that is outpacing supply and has been for 5 years now, and it continues to increase, meaning the deficit increases. So it's got a real problem in that regard. So that's the other wave that most people are focused on that. Oh, the silver demand because of this, that, and the other. They're forgetting its money. And it's very undervalued to its mama metal, gold, historically. Uh, and this is one of the trigger levels that caused silver to do what it just did in the last 8 weeks. I'll explain it to you. Silver ebbs and flows versus gold. It goes up in value, down in value, and you can plot it on a chart. And we do it a little differently. We don't do the ratio. We divide an ounce of silver into an ounce of gold, and we get a percent. And if you go back over 50 years, like to 75, and plot what was the best reading that silver had that year, monthly close, versus gold, what was the peak relative performance reading? And we plot it, okay? Well, back in the 79 to 80 bull market in silver, which was still within that range, the half century range of $4 to 50, $4 to 50, that surge in 79 and 80, which in the last 5 months of that ongoing bull market already for silver and gold, silver went up 4.5-fold in 5 months, reaching $50 for the first time, 1980. Okay. What caused that already existing bull trend in silver to go ape on the upside and do it bam like that? Totally changed the nature of the reality that was under expected. Okay. And then in 2010 and 11, silver had already been going up for years again, along with gold, but layered type go, advance. Frustrating for the bulls, but still up, up, up. And then suddenly in September of 2010 through April of 2011, so it's 6, 7 months, silver doubled in a half in price. In September 2010, it was like in the 20s. Suddenly went to 50 again, bam, bam, bam. And it did it for years of advance. Suddenly in the last couple quarters, it went crazy. Again, stopping at the top of the old, what is now a 50-year range, was a 50-year range. What caused that explosion? Why didn't it just go up to those highs in the same manner that it had been going up already? Why did it go crazy? When you plot the spread of silver versus gold during those times, you'll see that there was like a ceiling. I'm talking technically now. On that spread chart, every month you'd plot the difference. And there was like a shallow ceiling that prevailed during that bull market of silver and gold, where silver just couldn't get above a certain level in relation to gold. And suddenly it popped above it. And that would have been in like the summer of 1979. And when it did, that's when the price of silver went berserk, quadrupled in a half in 5 months. And then in 2010, it was September of 2010, already going up in price. Silver was in the 20s. And that spread also broke out over a ceiling that any idiot drawing a chart could see if you plot the spread chart the way we do. And boom, in 7 months, it doubled in a half. Okay. Same thing happened this time, except even more clear on the spread chart, even a wider base spanning 10 years of ceiling of silver to gold, silver to gold. Couldn't get above that ratio, that percent. And the November close broke out above it. Bam. Suddenly silver goes crazy. Uh, that span of time we find in a lot of other markets in those rare periods when a market has been stuck in a range for multiple years, decades. Copper did this, for example. It had been in a range from 50 cents to $1.50 in the 1970s, 1980s, 1990s, into the year 2005. And in the latter part of 2005, it broke out above that range, and in a matter of a couple of quarters went to $4.50. Bam! $1.50 to $4.50. On its own. It wasn't associated with, for example, other base metals. It did it on its own. It wasn't even associated with what gold and silver were doing then. A year and a half later, lead did the same thing. You could plot a lead chart going back multiple decades, and it was in its old reality. And when it broke through that, in several quarters, boom, it quadrupled in half in price. All compressed within a couple quarters. Again, on its own, wasn't associated with the copper move even. So we've seen these events occur in other markets where an old price reality, which has existed so long you can't believe it, you're bored by it. You think it's the real reality to live forever. It doesn't. And when the market moves into a new reality, sometimes it does it in an exaggerated manner, in a speedy manner. We know this in other markets, like, we see bubble tops in the stock market, and a lot of people look back on them and say, gee, I should have known that. And sure enough, the collapse that followed was pretty dramatic. Dot-com top to the 2002 low. NASDAQ 100 dropped 82% in 2 years, fully wiping out the entire dot-com bubble, okay? 2007 to 9, similar type process. But the point is that when a market has done something in error, either excessive on the upside or excessive on the downside, in this case for silver, caught in a 50-year range, when you can look at every other market in the world, copper, lead, gold, they weren't caught in that 50-year range. Copper's range was 50 cents to $1.50, and it's living in the 450 level. Now it's 5 something, almost 6. When you stay stuck in that kind of range, and yet silver for some reason stayed in that range for 50 years, despite copper breaking out of its range in 2005, lead in 2007, and gold at each of its bull markets would vastly exceed the prior high. It was 850 in 1980, then it was 1920, and now it's 4,000, et cetera. So why was silver contained? What's going on there? It made a mistake. Now, maybe it was a coerced mistake in effect, manipulation, and we understand that, where the certain banks and association, possibly with central banks, might have been playing a game to try to keep it capped down for some reason. Ultimately, that failed. Okay. But when silver unleashes itself as it has now, I expect in the next couple of quarters, since that spread breakout, that probably you're going to see a dynamite move that will drop jaws. It's not going to be incremental. You're going to a new reality. And it wouldn't shock me that it's in several $100s. And, they're like Eric Sprott, I think I gave a talk after he did in Toronto back in October. And he noted that, if you deflate silver or adjust it to the monetary growth, it'd probably be $200. It would be fair just to match the old highs. when you factor in the decay and the quantity of the number of dollars in existence. Well, heck, yeah. Well, let's say that's a new normality, a new reality that would make sense. Well, but when markets go from excess, they quite often, one way or the other, they go excess the other way in the process of getting to the new reality. I think that's where silver is right now. And so the people who are constantly saying, sell it, take profits, it's going to go back to 50, it's got to go back to this old high here or there or whatever. And then, like a week or so ago, we dropped 15% in silver in like 2.5 days. And a couple of days later, you're back to the high. What are they thinking? Don't they realize that this is not a normal advance? You don't get these multi-month corrections anymore. Now they're measured in days. And frankly, we expect to see silver reach. My minimum is like 200, but I wouldn't be shocked but if it approached 500, to tell you the truth. And there's certain other factors in play in that regard too. We can talk about if you want to.
Yeah, I would love to hear more about those factors. And also, if you could also elaborate on what else has been suppressing this metal for so long, not just in terms of the charts, but even other fundamentals. Because I'm also seeing too other bullish factors, like even China hoarding silver like crazy and this whole silver war coming out. So, what are some other factors on top of
I
that?
don't know what's been restraining silver, except that we do know there has been deliberate attempt to keep it down,
Hmm.
banks and so forth. And I think there's actually been some convictions, and marketplace convictions, the Justice Department, and so forth, of attempt several years ago of attempt to, manipulate the market. So, but we don't analyze silver from that point of view, the fundamentals. So we know we have a supply demand deficit. We've had that for 5 years. Why is silver only now responding? Well, pent up pressures. Uh, the ongoing demand by China, essential for their solar panels. They're 80, 90% of the global solar panel production, and silver is essential in that. And also, we hear all about these AI data center, power centers, so forth. Well, silver is essential in that, here, there, and everywhere, in micro form and larger form. You can't get rid of it. It's essential because of its nature of the metal. And so those demand factors are continuing to grow, and it's not been priced into silver, the supply demand issue. And so if it's made an error in not already responding to that by incremental growth to respond to that ongoing demand, which it's not done, then when it catches up, it just does it in a maniac way. And actually, it's rational because it gets from point A to point B where it should have been anyway, perhaps 10, 20 years ago, and does it in a lightning form. And copper did it, lead did it, gold does it every bull market. In fact, a point about gold right now, the mama metal. It's not a primarily industrial, it's primary money. Okay. You had in of the last 50 years since the government legalized it, quote unquote, you had the bull market. It peaked in 2000, but dropped into 1975 when it was legalized. As soon as it was legalized, it peaked and dropped to $103 in mid 1976. That was a bear low, 50% pullback. From that 76 low at 103, it went to 850 in 3.5 years. Okay. Eightfold gain. Bear low, bull high. Okay. Then for multiple decades, it went sideways, but where? The two, three, $400 level. Okay. Well off the 850 high, but still way above the old reality that prevailed in the 1970s and so forth. In 2001, it made a low at around $260. And a decade later, it was 1920, another eightfold move, bear low, bull high, under conditions that aren't anywhere approaching the fundamental realities that are now underlying gold. Okay. Gold's bear low this time was in 2015 at 1,050. Eightfold, so somewhere about 8,500. Okay. We're at 4,500. We're only a fourfold move. We're only half the dimension of the prior two bull markets. What if gold does it again? Which is hardly like a shocking thing to have another eightfold move. Okay, big deal. Wow, where would silver be if, let's say, silver now rushes up to, let's say, 2% even? an ounce of gold. Oh, wow. What would that be? 8,000 gold, 2%? You get the point. What if gold doesn't stop at its old eightfold move again because something different's going on this time? And what if silver, instead of going to where it's been in the last 50 years, that relationship has at least been 2% in 20 of the last 50 years? Divide silver into gold, at least been 2%. We saw a low this year at about 1%. Dirt cheap, free silver compared to gold, okay? If silver doesn't just go to the norm of 2%, which it's been 20 years of the last 50, and does what it did during the bull trends, if you go back and look at that spread relationship in 79 to 80, it was 6.5%. Or in 2010 to 11, it reached over 3%. That's a doubling from where it is right now. Okay, so instead of 2% of the price of $8,000 gold, let's say, assuming gold only does the norm, what about 3%? What about 6%? Which is what it did in the last two bull markets. We're in a bull market now, so wouldn't the spread go up and at least challenge the spread relationship it had in 1980, 2011? Heck, prices above those highs. Why shouldn't maybe the spread relationship also go up and challenge those highs? So the ceilings come off silver, both in its relationship to gold and its own technical situation. So it's a monster. And if you don't treat it that way, and if you treat it like, oh, RSI is overdone, you'll miss the move. In fact, the fact is that if you do monthly RSI, popular so-called momentum metric, we ignore it, but it's popular. In the 79 to 80 move, RSI on a monthly basis got above 80%, which is the upper, overbought level for a year. So when it first got to 80%, if you said, oh, I'm out, it's overbought, you missed the entire move. From like the teens to 50. Okay, you missed the whole move. So take your norms, throw them out the window. We're not in a normal situation. That's our assessment. And admittedly, yes, if we get what we expect in the next 6 months, then yes, we'll be more cautious about perhaps locking in, especially leverage positions or call option positions. I don't think silver is going to ever collapse again. It may collapse from, let's say it goes to $400 in 6 months and drops back to 250. Yeah, it'll collapse. But going back down to this old reality is not going to occur. It's leaving it. It's going to much higher levels. And if you're not there for the next 6 months, I think you're going to miss it.
Michael, I am curious to ask in terms of this new reality of silver
Yeah.
going triple digits and that being normal. Sometimes people question, yeah, but what if it gets pulled back? Sometimes in bull markets, there's these corrections. You
Yep.
had
Yep.
mentioned before that, yeah, it's so strong that it could take a couple of days to already recover. So
Mhm.
if people are tuning in right now and they're more concerned about, they understand silver's value and gold, they're in it for the long term, but they are worried about maybe the
Mhm.
short term. What would you like to speak about? Because I know you have a lot of conviction in the next six
Mhm.
months.
Mhm. In the middle of those two post-spread breakout surges, where silver broke out versus gold, and it went crazy. Okay, basically, let's call it 2 quarters. They were slightly different in terms of months, but basically ballpark 2 quarters of a move. Okay, they went up huge in percentage terms, but in the middle of each move, time-wise, about let's call it 3 months into the move. Okay, you need to get more cautious about a stumble because at each of those times there was a midpoint stumble, not like what we just saw where it's 2 days and over with, which is going to be normal now. We expect to see 10 to 15% swings in silver, maybe by the hour. Okay. But 2 days down and you thought it was going back up, and sure enough, it's back to the high 2 days later. Okay. But in the middle of both those moves, there was what you could call a correction. I think it was January of 2011, after the September 2010 spread breakout, silver surged. And in January 2011, on price charts, it had a monthly reversal. I mean, it made a new high, but closed down on the month. So all the technicians say, oh, that's a reversal. That's the top. There was no follow through to the reversal the next month, and you really exploded after that. In 1979, in the midst of that mid 79 to 19 January 80 move, there was also a stall. It wasn't a monthly reversal, but it was several weeks drop and then congestion. So, if you'd been call options then, time sensitive, or in 2011, in January 2011, when you had a midpoint pullback, it would have been important to sort of pay attention, especially if you have a sensitive, time sensitive leverage position. Now, if you're invested without leverage, like in miners or silver bullion, I think you need to ignore it. Don't take profits. It's a midpoint correction. We might get one. I don't know. These dynamics this time, remember, we're outside that box now. Those corrections occurred still within that $4 to 50 range. Okay, so there was a midpoint correction even in those surges. But we've come out of that 50-year range. So, maybe there will, maybe there won't, but I'm cautious that there could be. If you take an arithmetic chart, meaning a regular dollar chart of silver, and go back 50 years, you'll see that range, monthly chart, high, low, close. Okay. You'll see $50, $4, $50, et cetera, et cetera. If you take the dimension of that range in dollars, it's like a $45 range or so. Let's call it $50. Okay. You add 50 to 50, the breakout point, you're going to 100. And we know that there's a lot of traders out there who like to play these big round number games. Like remember 3,500 on gold? They stalled it for 5 months there. Big round number, 3,500. Let's sell it, sell it. Silver was stuck at $35 for a whole year, late 24 to early 25. Whenever you get the round numbers, they tend to like to play games there. Well, it happens that that's an arithmetic, orthodox swing measurement of silver added to the breakout point. Would say, hey, I'm going to go to 100, which is to double the range. Okay. If you take a logarithmic scale chart, which is far more important here, a ratio scale chart, which again, gold continues to blast out on that, eightfold move, eightfold move. It's just, like that. Silver's been capped. If you take a logarithmic scale chart, you have a tenfold range there, $4 to 50. Take the low price multiple times 10. Okay. It lived in that range for a half a century. Okay. You break out at 50, what's tenfold? $500. So don't be shocked that this move in silver in the next 6 months or a year, but most of it compressed, I think, again in a couple of quarters, could reach something like that. Not the silly arithmetic, everybody sees the chart type move. Oh, $50 will go to 100. That's where you take your profits. So it wouldn't shock me that maybe around that idiot level, you're going to have some game playing. Of course, right now we're trading either side of 80. So, another $20 or so. So I'm sort of ready for that mentally, but I also know that if that occurs, especially soon in the move, like only in 3 months of upside, then you're only halfway through that surge. And this is a midpoint correction on the clock, at least. And it wouldn't shock me that if you go to near 100 or $96 or whatever you want to do, somewhere around there and get a correction, it's when you turn through that, you're really going to go electric. But there could be a correction there, and MSA is focused on trying to define that if we see the evidence. So, for example, the other day, last week, when we had this 15% drop in silver, we said, boo, it's not a drop. And everybody's screaming, it's a top, it's over with, or it's going to have to correct for 6 months and go back to 50. We said, baloney. And this time around, instead of taking 2 weeks to get back to the high, like in October, where it spent a whole month laboring, if you'll recall, had a sharp drop, but it took it a long time to get back up. Took it 2 days, bam. That's the nature of the market you're dealing with. Realize it. Be there. And if you got options, I've got options in my account. I'm going to be cautious somewhere in the midpoint of that clock. And especially if we get up around 100, I'm going to be looking for any reason that tells me, yes, there's some technical reasons to assume you could get a $15 spill here or something like that. So that's my thought on that issue.
I'm curious to get your opinion on that issue of maybe price falling dramatically if that were to happen. isn't that also an opportunity though to add to your position on this
Yeah, yeah.
long-term
If you're not
surge?
already in, yeah, I quite agree. Yeah. So if you do get that, if you do reach that level, the idiot level, rapidly, like, next month, let's say, that's very early in this explosive cycle. Uh, yeah, if you're not in, you might want to look at trying to capture where that turns back up again, which is pretty hard to do, by the way, because when silver turns back up, like we just had the other day, it was a bam, bam.
In two
A
days.
couple of days, yeah, right. So it's hard to do. It's not that easy. You have to really look at micro technicals. And our view right now is on the macro. And we sense, we assess, we continue to that this is different this time. If you treat it as normal, you're going to miss it.
I really appreciate that answer. And as you know, I'm all about education. And I've been getting a lot now, sometimes from Gen Zs or even from friends who live in Montreal who are more aware of what's going on, probably because they've been hearing me talk about gold and silver for the last 5 years. But a lot of times
Yeah,
they're almost
yeah.
like, yeah, but I feel like I missed the boat then. What would
Uh,
you say to people like that?
Well, yes, you have in the sense that MSA turned long-term bullish. We've been bearish and bullish on gold over 30 years, okay? For instance, in 2011, it peaked late in the year. January 2012, we were major bearish. Stayed that way till February 2016, 6 weeks after it made its bear low, and stayed bullish since. So we got bullish at 1,140 price of gold in February 2016 based on annual momentum, and nothing since when annual momentum has said it's over. Yeah, big corrections, but nothing said the trend is over. It's still up. Okay. And now it's in the acceleration phase. But that spread relationship of silver to gold is exceptionally potent right now because one, it's the breakout has just occurred. And sure enough, what was the price response? Silver went crazy. Okay. No surprise to us, but to a lot of people it was. The spread told you, I'm going to blow my cork versus the mama metal. Okay. But that just occurred. So yeah, it's quite a few quote dollars arithmetically speaking above the breakout over $50 where the spread was when it broke out. But it's really just begun. And now 6 months from now, you can't say that. But I think now you can say that. It's still not too late because silver valuation to gold is off the page, still dirt cheap. And the spread technicals tell us that historically silver's on its way to a rampage versus gold. So even if gold just goes up to the normal high of 8,000 and takes you 6 months to get there, and everybody says, oh, that's got to be the top. Well, it's matched, it's done it twice before. Maybe it's going to be different this time. We got a crisis on our hands of major proportions. This time we got government debt crisis here, Japan, UK, etc., where the government bonds, the core of the asset world, could come into doubt. And, like President Williams of the New York Fed in mid-November made a speech or a press conference, and he said the Fed is going to start buying bonds. And his explanation for that was, and we know they've been, because you look at what they've been doing lately, they've been buying the hell out. Okay. He said only because of illiquidity in that market. Not because they're afraid it's going to collapse, but because, and rates explode, but illiquidity. That's a nice way to avoid the issue. But they're very concerned about it. The Japanese are too. I mean, we have a government, we don't have a mortgage crisis this time. We have government debt, and that is bigger than the entire US stock market. And they've been buying and buying and buying since November, and bonds have gone nowhere except sideways. And our assessment of T-bonds right now, which is the quiet one, watch out for him. When he wakes up, he could do violent things. It's been 118 to 114 and a half for like since November. Right now we're trading at 116. All they're buying has not boosted the bonds. They've just gone dead sideways in price, meaning the yields on 30-year are at the highs, just sitting there, not breaking back down. No relief on long-term debt. And subgroups in the stock market like commercial real estate, which is a huge subgroup, which is a very anemic sector, has been going sideways in the middle for the last year, in the middle of its 10-year range. It hasn't made new highs with the S&P. It hasn't broken down yet. And everybody thinks, oh, well, it hasn't broken down. It must be okay. Watch the T-bonds, because if they roll over, like they're 116 now, you don't ever want to see 111 again. Look at a price chart and say, well, we've seen 110. What's the big deal about 111? Our momentum structures say you go there, you're going to get an implosion. Now, admittedly, they're going to come out with fire hoses. Bank of Japan, Fed, et cetera. Central banks are going to go ape and they're going to print money like crazy. Well, what's the beneficiary of them destroying the money in it? Gold, silver, real money benefits from the decay of fiat money. And that's the history of gold and silver as well. So that's the other wave underneath here. And watch the T-bonds, because if they can't control that market and it slips just a handful of points on the T-bond futures, we're looking at March futures right now, 30-year bonds. They're at 116. You don't want to slip off even a couple points, especially 4 points, because they're going to blow the bottom out of it. You're going to have a panic in the bond market, which is not on anybody's horizon right now. Everybody's looking at what's NVIDIA doing. Okay. Who cares? Yeah, NVIDIA ultimately is going to pay the debt for being the excessive sector, the AI sector. But it probably won't be the provoking one. And frankly, right now, we view the stock market as stable and likely on an intermediate basis to probably even go up a little bit more. Maybe get well into the first quarter before you see any rollover at all. And I don't see, by the way, what a lot of gold miners investors are afraid of. Oh, if the stock market goes down, we go down. No, it doesn't. A few times in history, gold and miners suffered. October of 2008 is the most conspicuous single standout month, where the stock market already a year off of its bull market high, already substantially off of its bull market high, which was October of 2007. Okay, so October 2008, it had what you could call a crash month. And gold and silver joined, and so did the miners. And gold turned around within a few months, was back to the high, new highs. Stock market continued down through 2009. But what happened after that crash in October of 2008, which did, gold was ripe for a correction at that point, by the way. It had been going up massively for years. And so it was due for a nice sharp break. And so it had one. And everybody thought, oh, man, it's the end of gold. No, in a matter of months, it was back making new highs, and S&P continued down. So that myth ended. Yes, there was a 1 month that stood out as in sync. But look what happened January through April. Gold rose, stock market broke down this year. How come gold didn't collapse? Gold went up. Like, what did gold do? It peaked in April, 3,500. Stock market made a low. They weren't in sync. I don't think the stock market in the US is about to have a crash type event. I think what's more likely to happen in our assessment of the S&P and the NASDAQ is that this upside crawling effort that we've had for like 4 months now, where every month you get the S&P up over 6,900 and it sells off but doesn't go anywhere, 6,900, 4 months in a row. I think you'll probably get over 7,000 and go on. Who knows? Maybe we get a decision from the Supreme Court on Friday that says, we're going to block the tariffs in some way. And the market thinks, oh boy, it goes up. It doesn't look ripe technically to roll over yet. And when it does roll over, I don't see the danger of a rapid rollover at this point. I'm suspecting you're going to have to get into the second quarter before the S&P ever gets back down to numbers that we would define as, the bottom comes out. And those numbers are down well below where we are right now. We're going to get in the mid 5,000s again, like 5,600, before you trigger numbers that say, okay, I can implode. And so, yeah, I think the S&P is likely to go up for a few more months, which means, hey, if you're in gold miners, no problem from the stock market, if you believe in that correlation myth, which is very few examples in history validate that, by the way. And even when it does roll over, I don't see it being sudden and dramatic until you get back down toward those levels. Remember, in April, we got to 4,800 on the S&P. I'm saying if you get back down now to 5,600 anytime this year, the floor could come out. But that's a long way down there, and the process of getting there could be laborious, meaning not panicky, which means probably, if you're using that as your scare thought, I'm in gold miners and I got to be scared of the stock market. I wouldn't be scared. I don't think you're going to get drama out of the stock market on the downside until you get back to that level. And that could be a process. We may be well into the 6 month period of the silver explosion, with miners also exploding. And the stock market's still just copacetic and no threat to the miners. Anyway, that's my thought on that issue, is that the stock market's not a threat right now. It is a threat if you're an investor. I don't think you should be long the stock market. I think it's topping. It's been topping since January, and I think the new highs are just teaser highs, which also occurred in 2000 and in 2007, where you look like you topped and made a new high by about 10, 15%. And then, you know, a year later, you fell apart. Anyway, so from an asset point of view, if you're in miners as a category, and I emphasize them right now too, I think they're going to beat gold going forward this year. I think they're going to be the better place to be than gold is, just like silver is going to be better than gold. But I don't think the stock market is a threat to them at this time.
So knowing that gold and silver is the place to be, and knowing that it dramatically performed last year, I'm curious to ask you if we look at now the ways that we can invest, like for example, the miners, you were just talking about them. Do you think they're undervalued right now? Do you think they've
Yeah.
already
Oh, yes.
with
Oh,
the
yes.
prices?
Yeah.
Could
Yeah.
you talk more about that?
I don't have the chart in front of me, but we've run it many times. Go back to 1986 when the XAU index began. GDX only began in 2006, so it didn't have that much history. But XAU is the Philadelphia Gold and Silver Miners Index. It's not an ETF, it's an index. Back then, in the 1980s, 1990s, into 2008, so for multiple decades, if you divided the price of XAU into an ounce of gold, you ended up with the percentage readings that were on the bottom side about 17 to 18% would be low for the XAU value to gold. And the upper side was like 35%. So it lived in this almost 20-point range of spread readings, up and down, but holding its value at, let's say the midpoint of that's about 25% or so. Okay. Quarter of the value of an ounce of gold. 2008, it broke down relative to gold on a spread basis. You could plot the spread chart, you could see the floor come out. And it dropped all the way by the bear market low in 2015, when both gold and the miners made their actual price lows. That spread dropped to 4%. Okay. It had been living in an average of 25% for decades, up and down around that level, in its valuation to gold. And it dropped to 4%. I mean, what do you think it's going to do? Go to zero? Miners are worth nothing? Okay, that's effectively what it did. And since 2015 low, that spread has rallied up to 8%, just over 8, and dropped back down to about 5. Rallied just up over 8 again, and this would be 2021. The high reading then was 8.6%, and it fell back down again, and now it's back up to about 8.2%. So this is the third assault in that 10-year wide range of spread reading. Still very cheap. I'm talking 8% now, okay, versus an average back in those decades of 25%. So it's still dirt cheap compared to gold. We think this rally is going to blow through the top of that box, that 8% to 5% zone. And when it does, it's likely to go double at minimum in terms of its relative value to gold, just to get to the bottom end of what had been the multi-decade range with lows around 17, 18%. So if we're 8% plus now, and we're going to double, go to like 17, 18, just to bump the bottom of the old relative performance readings. And I think that's likely to occur fairly quickly. It's just like that silver gold ratio spread relationship that broke out in November. Poof, silver beat gold dramatically in price. The miners are now positioned to do the same thing. And my son Brett has pointed out to me, I didn't know this, but in February, there's going to be a lot of miners' earnings reports. They're going to be shockers. Because, I mean, if you're the kind of investor who depends on that kind of nonsense to whether to buy or not buy, what are its earnings? Okay. Those are based on the price of an ounce of gold versus its production cost largely, okay? And, 6 months ago or so, gold was where, 3,000 or something, okay, 3,005. And all of a sudden we're 4,500 with production costs stable. I mean, oil's come down, it's gone stable anyway. And so the production cost, the main cost, is not rising. And yet gold has exploded. So the earnings would go through the roof. And no doubt a lot of people who depend on that kind of stuff for affirmation are going to say, gee, I got to be in this. Wouldn't it be coincident that that spread breaks out between now and early February? And as those earnings come out, people say, now I got to buy the miners. Now I believe in them because, the earnings look good. And you get a gusher. So I'm expecting technically, and from a valuation point of view, again, we're 8% compared to a reality that existed before on an average of 25%. Wow. How cheap are they going to get? They've already said, I'm not going lower. The issue is when do they break out? And I think it's coming. And within the miners, I'd further accentuate the silver miners over the gold miners because they're even cheaper in historic valuation. And they have the technicals to do a whoosh.
I have a question around silver and gas and oil. If we
Yeah.
look if we look at like in 1980 was
Yeah.
the last time when silver was more than oil and gas.
Hmm.
So I'm curious to get your perspective, even if we're early right now to be talking about just oil and gas. What's your opinion on oil and gas?
Natural gas has already come well up off its lows on a percent basis. Oil is not. I mean, natural gas was down like a buck and now it's $4. Okay. So no, it's not up to 10 again, but it had a huge surge off its lows. So it's a different category. Um, Crude oil and things related to it are very depressed. In fact, if you ran spread charts of the price of oil versus the S&P or price of oil versus gold, or price of oil versus silver, et cetera, it's off the page cheap. It's like, what are you going to do? Go be free? Okay. Now we have news events right now that no doubt are influencing people. And I've seen a lot of analysts on TV who quote oil experts saying, no, oil's going back to 40. Supply demand situation's very heavy. Da, 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 da. And this Venezuela thing, more oil is going to come, et cetera, et cetera. And all I can say as a technician is watch yourself. Because as oil has come down after that $130 high in 2022, and interesting, it peaked right after the war began, Russia-Ukraine war. It didn't go up because of it. It peaked shortly after. It had been going up for a whole year before that, a year and a half, in fact, up to 130. Most of that occurred before the war even started. And then when the war started, which surprised a lot of people, oil peaked and collapsed from 130 down into the 70s. And basically, for the last several years, gold has gone sideways 23, 24, 25, in that 70, 80, even 60, lower 60 range. Okay, so it just be sort of boring, but dead and very cheap, less than half the price of its peak in the 2022 high. Now it's gone down in the upper 50s, now the mid 50s almost. And I have a sense that you're about to have, I hope we're going to do this, a plunge, like a little vortex type plunge where, oil goes down to 52 or 50 or something. And people just screaming, it's going to collapse, going to collapse. Because the technicals are set up on oil, our technicals, where we run momentum studies of long-term measurements of oil. There's a massive trend structure. If you looked at the price of oil, you don't see it. You just see this layered decline. But when you look at our momentum charts, you see a multi-point, like a 7-point downtrend on quarterly momentum, which is a fairly long-term metric, that has been banged and banged and banged. And you also see a ceiling that's about coincident with where that trend line comes through. You don't see it on the price chart. Oil right now wouldn't have to go up but a solid handful of percentage points from where it is now, not double-digit percent, okay, to and to price levels that most people wouldn't regard as a breakout during this quarter, and you're going to break out over that stuff. And when I see a structure like that built, it's as if you saw a price chart with a 7-point trend line that looks tired. It's been going down too long, and you know the structure is right there. It wouldn't take much to break out. You get excited. Oh boy, this looks like a breakout pending. You don't see it on the price chart, but you do momentum. I think oil is about to make possibly a vortex low, where you make a low with some headlines, like what's going on now. They think, oh, well, that's gonna the oil just gonna puke. Okay. That fundamental analysts are right. And when you come out of there, probably without a reason, no headline, just I'm done. Okay. It vortexes out of there, and this is often the way markets turn. They don't do it with a headline. They do it just because, hey, I'm tired. I'm going up. I'm too low. You could volt out of there, where suddenly oil becomes a component. It is a component of the Bloomberg commodity index, but it's the most lagged component within the entire Bloomberg, which is advancing now. The Bloomberg commodity index, as far as we're concerned, has begun a second major bull leg. Started in October, price of 106. We're now trading 113 or so. Oil is the weak component, but it looks like it has the attributes to do a real V-bottom type turn and not only make an exhaustive low, a panicky looking low like it's going to collapse to never land, and just turn out of there and shoot up, $20, $30 very quickly and shock people. So right now, our view on oil is don't buy it yet, but be inclined to think about that. Because especially if you can get that kind of panic low, where you hear nothing but on CNBC and elsewhere about how it's going to go to, it's going to 40, it's no good. Trump was right, all this stuff, where you could come roaring out of here in that market. And I'm not going to explain why. I don't know why. I don't care why. I'm measuring the dynamics. And it says I'm cheap. I'm cheap in relation to everything else. Like you said, silver versus oil. Well, how about if silver stays at that level, but oil goes up? And so silver goes up more and just stays at that. You get the point? Because that spread relationship could change. If oil goes up, silver could stay at that relationship and go up, continue as well. Okay. But oil is dirt cheap. And it looks like it could explode about it here. So that's a market I'd be watching for, again, an ambush type event.
I really appreciate that explanation because I do feel as a contrarian and value-based investor, it's always important also to be thinking about where exactly should we be watching with our capital and other opportunities. So even though I'm very bullish as well on gold and silver, I do find it's important to be aware of other markets. Are there any
Yeah.
other commodities
Yes. Yeah. Oh,
that you want
yes.
to
Now,
talk about?
in general,
Mhm.
broadly speaking, if you recall the late 70s, you probably don't, okay, but in the late 70s, we had a worldwide recession called stagflation, and commodities late, but joined gold. Gold made its low in 76 and went up to 1980. In 1977, the CRB index, which is the key commodity index then, turned up as well. So a year behind gold, okay, and joined and had a powerful move with gold up through 1980. The stock market was in the mire. It was what every brokers called it, a wasteland. I remember I was a commodity broker then with Prudential Bache, and all the stockbrokers in the office hardly even came in the office anymore. Their phones weren't ringing. The stock market was a wasteland. It'd go up and down, but wouldn't go anywhere for like a decade. But anyway, during that time, commodities exploded in a global recession, which most people say, how can that happen? Well, it did, because when they print money, it went somewhere. And when it goes into the cheaper assets that are perceived to be lower risk, greater reward, gold was certainly one. It always benefits from when you go into a recession or depression, the central banks print. Okay. Well, I think we're facing that right now. And I'm seeing measuring the Bloomberg commodity index versus the S&P, for example, it looks like oil does versus silver. It's off the page cheap, but it isn't going down. It's been stable. The Bloomberg Commodity Index has been stable for like a couple of years now, either side of about 2% of the price of the S&P. And there's some levels on it that look like it could turn up, but on a net trend basis, Bloomberg has already, in our assessment, turned back up from its first leg that peaked in 2022, had a 50% correction back to its bare low, which occurred in 2020, went sideways for a couple of years, and now has broken out. I think it started. Now, oil is the weakest component, admittedly, but a lot of other components are quite firm. Base metals are quite strong, as you know. If I were an investor, one, I would have a lot of it in monetary metals. And if you don't want the leverage, fine. Just buy miners, buy bullion ETFs, or buy bullion. Don't leverage. Commodity complex looks like an investment arena that is in the early phase of a turn, so you're not late. And especially when crude oil does that flip that I think it's going to do. That's when suddenly you're going to be aware that, oh my, real world assets are a place to be. Stuff that's in the ground or just above the ground. Grains, foods, cattle, oil, copper, stuff that you can step on and touch, not paper assets that have this dream world built around them. AI is going to change the world. Yeah, it might do that, just like .com did, but it had an 82% bear market in 2002. Remember that. Okay, the .com. AI could do the same thing. But I think people are going to turn their heads to that which is real and cheap off the page, not only relative to the stock market, but relative to its own prices. Like the Bloomberg Commodity Index right now is 113, let's say. Okay. What was its high in 2008? 237. Okay. So we're half the price of where it was in 2008. And in 2011, it made a secondary high at 170 something. And again, we're at 113. So even now, commodity prices are still low relative to themselves, much less the stock market. And all our technical signals are saying shift from the asset preference of stocks, other than gold miners and mining stocks and commodity related stocks, and shift into commodity related stocks, ag related, metal mining related, oil related, especially when oil makes that turn. I would suddenly take a strong look at some of the oil sectors, which are also fairly depressed. XLE is not, but a lot of the subsectors within the oil complex are fairly depressed. And so if I were an investor, not thinking out the next 6 months, but the next couple of years, not wanting to use leverage, I see that as a bargain basement, safe place to be. So if you don't want the volatility, but you want to buy low and sell high, that's buying low. And I think it's proved itself. I'm not going lower. Only issue is when am I going up? And I think that's begun.
I appreciate that explanation, Michael. And I'm curious to ask a follow-up question on that. I've been in the space for 5 years in the precious metals.
Mm-hmm.
I've also invested in the major and junior miners, obviously a lot more risks, right? So if someone was new right now listening to this conversation
Mm-hmm.
and they
Mm-hmm.
have the
Mm-hmm.
conviction that you and I both have, but they're
Yeah, yeah,
maybe overwhelmed with how to even just put a little bit of their money.
yeah. I would focus. Uh, Silver's going to be volatile, but the miners, especially the silver mining component of the gold silver mining sector, is the most depressed. And I think it is the one that could have the most extreme volatility and price gain on the upside in terms of multiple gains. See, I'm talking about silver going into a couple hundreds. I think that's going to happen. Well, the silver miners, if you look at GDX right now, the gold mining ETF, it does have some silver miners in it, by the way, but it is well out above its 2011 price high, well out above it. It blew through that a couple months ago, and it levels well above that. The silver miners ETF, is still below its 2011 high. Its high back in 2011 was a high close in the mid 80s, I think, and we almost matched that last month, but didn't quite exceed the high close, monthly close. But the high monthly trade back then was like 94. This is 1911 when gold was up at the 1920 bull market peak. Okay. Sil was at 94 top trade. Where have we been in the recent surge? Just above 90. They sold it. Said, hey, I'm going to sell the old high. Okay. They got a nice drop down to the low 80s. We came back up near 90 yesterday. Didn't quite touch it again. I'm going to bet if you touch 90 one more time on Sil, this is just price because momentum already says be long. Long-term momentum says be long. This beast is yet to do its thing. You touch 90 one more time, and the guys who've been selling that old 2011 high, $90 rounded off, are going to finally realize, oh, this ain't working. And I think the silver miners could go berserk, just like silver does, and outpace the gold miners. So if I were buying right now in miners, and I have a lot of them, I'm emphasizing silver miners. I've got call options on silver, SLV, but I've got also leap options on some of the major silver miners. But I'm also buying a lot of the junior silver miners because I think that category could go berserk in percentage terms, even more so than the gold miners. And again, I think a lot of that could occur in a couple quarters.
I appreciate that, Michael. And Michael, I want to move to a question that's a little bit more personal. You have 50 plus years of experience, which is like insanity when it comes to experience in the markets. And I'm sure there's lessons you've learned as an investor, but also lessons that you've learned that's taught you about life. I find in finance, we don't just learn about how to become a better investor, how to know ourselves better, but we also think of lessons that we can apply to our own personal life. What are a couple lessons that you'd like to share?
Well, obviously, you want to be on the right side of major market moves because that helps your personal life. Okay. And right now, there's not a lot of emotion in the stock market, for example, right now, either way. We had a wave of doubt about AI a few months ago, but that's dissipated pretty well because NVIDIA popped back up in the mid-range, not to the highs again, but mid-range. It feels comfortable. So that fear, anticipation of a drop is dissipating. And so it's getting comfortable again. And I think emotion is a big issue here for any investor because usually the emotion comes after you get ambushed, not before. So most people don't anticipate the ambush. And so when there was all this attention on an ambush in AI, it didn't happen. It didn't happen. And I don't think it's going to happen for a while, maybe in a couple months. And by then, especially if the S&P makes a new high, which it's trying to do right now, and especially if, let's say, the tariffs are in some way impaired by the Supreme Court decision. And then people say, oh boy, party's on again. It's that comfort level that when that changes and you go to emotion, that's when bad stuff happens in the real world, not just markets. So right now, if you're an average investor, if you're not long gold, a lot of them aren't, especially in the Western world, the US especially, you're at least smiling because, hey, S&P was up 15% year to date, about 10% above the highs of early 25. But 25 ended up being an up year by small double-digit percent. So, hey, it's comfy. So my retirement account, if I look at it, and if it reflects the S&P, hopefully, let's say it did, a lot of people are still smiling. Hey, man, I had a positive year. Good, good. I weathered that. It's great. Only thing that looks good on your horizon is your retirement account. You're past due on your credit card. Many people are, or you're maxed out on your credit cards. You're having a problem with your mortgage payments. Uh, all kinds of debt-related problems are occurring. We know about it. We hear about it. And yet you got that one positive thing, so it keeps you smiling. And the gasoline prices too, right? Trump said he'd get them down. And fortunately, that part of the consumer expenditures is doing what he said it would do. Okay. Watch out on that though. So but what happens if all of a sudden those get upended? Then emotion comes into play because then you got nothing to smile about. Your wife just gets laid off. You have to go work at Walmart and you're 65. Uh, your credit cards, you're past due. You don't know what to do. You're borrowing money on these. All I hear are ads on radio all the time about we can help you with the IRS. I didn't think people had problems. We can help you with your debt problems. That must be 50% of the ads I hear on the radio. Sound like a lot of people are in trouble, and yet we're told everybody's happy. Okay. But anyway, when that stock market breaks, that's when the motion comes into play, and that's when the real world data points go dark real quick. And when emotion hits, and I think it's going to hit worldwide, not just us, we're not the only bubble. Europe is somewhat of a bubble, stock market. Japan is definitely a stock market bubble. India is a stock market bubble. But when that breaks, that's when you get the real world negatives and the emotion comes with it. And that's when all of a sudden, and I think this is a huge bubble, bigger than we've ever seen in the US history, stock market bubble. And when they break, other things break too. People get fired. things that you didn't expect to happen, and it goes dark, and suddenly it's 52 card pickup. And when you have emotion enter, that's when doubt occurs about institutions, what's going to happen next. Is any alternative in the political world really an alternative? We thought such and such was going to happen when Trump got elected, and suddenly a lot of things he's doing are opposite to what he said he would do. So a lot of the GOP are abandoning him even. So all of a sudden, the Democrat Party is totally fractured. It doesn't know whether to go moderate or go radical left. It's split between the two. So it's really two parties right now. Republican Party is piecemeal by piecemeal suddenly saying, hey, he's not doing what he said. I'm going back to Reagan and Goldwater principles, but Trump isn't that. So that party is fracturing. So institutions you think are forever aren't forever. And it's hands in the air. And then suddenly there's doubt about, oh, Federal Reserve didn't do a good job. They either print or they don't print, or they create bubbles, stock market bubbles, because of their monetary bubbles. And they're not in control of JS, okay? And suddenly that institution comes into doubt. Uh, Other institutions, other notions, income taxes. I'm not advocating, believe me. I'm just saying when people hurt, they get late on their income tax. And I hear nothing but ads about you're late with the IRS, we'll help you. I didn't think there was a problem. Well, if all of a sudden the American public gets hurt in a way that suddenly they not only can't pay their credit cards, but they have to ask for extensions on their tax payments, plans, or they simply don't file and hope for the best. That's when extreme emotion hits and concepts of normality go out the window. And I think we're probably going to face something like that this year, especially once the stock market not only rolls over, but hits those trigger levels, which I think they'll do. But it might be mid-year. But that's when all of a sudden emotion comes into play. So I've not really seen this before. In 2007 through 9, we saw a good chunk of it, but it only lasted for a year or so. And then they printed. And finally, at that point, the stock market was cheap enough. It had been, 1575 and it went to 669. Okay. So it was cheap enough to where you could buy it again. And the money printing they did finally helped the stock market. Of course, gold was already on its way. Anyway, don't be surprised by something like that occurring this year. So that's one thing I've not really seen, but I anticipate is something outside the markets, partly caused by the markets, but also what happens if suddenly there's doubt about owning U.S. government debt. A lot of countries around the world own a lot of it and quit buying it, and maybe they'll divest themselves of it. What if the American public no longer views that as a safe place to be? One of the major banks just came out, the CIO of one of the, I forget which one, was it Morgan Stanley, I think, came out with a thing. We need to get rid of the 60-40 principle. 60% stocks, 40% bonds is a, quote, balanced portfolio. He said, we need to go 60-20-20 with gold being 20. That was a hell of an admission. Timid, but a correct sense that something's wrong with that so-called safe category. If that ever comes into doubt, wow, it's like a global war almost in terms of the consequences. So don't be shocked if something like that materializes when these ambushes occur from areas even other than AI, like the T-bond market, or suddenly crude oil explodes for no reason except it's dirt cheap. Okay. Or suddenly the dollar index, which is already in a bear trend by our assessment, starts the downside again in a big way, which I think it will. All kinds of assumptions about normality go out the window. And that's the world I think we're facing in 2026. And I think silver knows it. I think gold knows it. And so this is not normal. This is not a 1980 bull market in gold or a 2011 bull market in gold. This is something different because of what's going on elsewhere. So as an investor, I think you need to be aware of that. I am. It's not happened before in such a big way, but I think it could be this time.
If this is such a historic time, which I also believe we are in that, and there's really a financial awakening coming, I feel like it's even beyond that. I even think there's a spiritual awakening coming too for people because there's going to be a lot of challenges, really, really
Yeah.
challenging who people are, how they show up, how they treat each other. And I think I have one question I've been wanting to ask you for so long
Mhm.
is it seems to me that you really, really care about humanity. You really care about not only people becoming financially well or being prepared, but it seems like just like the way that you speak about your son and you think highly of him, seems like you're also concerned about the everyday person and humanity. I'm curious to get your opinion on why you do what you do, why you show up with a lot of integrity for not just yourself, but even for others.
Well, I don't mix this into MSA's work. We're strictly technical. And there have been times I've been bearish on gold. So, even the Mama metal that I view as real money, there have been times we said, no, be gone. It's going down. That was 2012 through 15, and other times as well. But so I'm flexible on that. So even though I have certain guiding notions, you want to get into it. Uh, when I was in grad school working on a master's in 1971, 2, 3. I wrote a thesis called Anarcho-Capitalism. And at that time, I was a friend of and communicated much with Dr. Murray Rothbard, who was in New York City. I was in South Carolina.
Mm.
And we communicated via mail, and I went up and visited him, in fact, interviewed him on the sound interview that's available on the Mises Institute site. Uh, he was considered the founder of modern libertarianism. In fact, the Libertarian Party, I think, emerged in late 71 after I'd already met Rothbard. Uh, and since has stumbled around the Libertarian Party and fluctuated being semi-libertarian, libertarian. I don't really have a great interest in it. But it's a new idea. And it has, when things come upended among statist viewpoints, whether so-called right or left, and neither one of them seem to work. And I'll give you an example. Again, when I wrote that in 72, and it was a master's thesis, I think it was 72, 3, that was well before the term, Murray Rothbard had used it once, but in his correspondence to me, he said, you'll be the first one to write a thesis on it. So I did. Uh, and I merged the philosophical thoughts of Ayn Rand, but took away her politics, which was simply limited government, founding father type notions, but still pro-government, having government, and substituted them with Murray Rothbard's economic politics, which are totally libertarian, meaning ultimately we can evolve away from that. No, we're not going to do it overnight. And it's not violent. No, it doesn't seem to work. We've gone through all kinds of cycles of extreme right, extreme left, moderate, and so forth, and they all tend to implode at some point because of errors they create. Well, in Argentina, over a year ago, Javier Milei got elected president. He's an economic academician type guy, young guy, looks like a rock and roll star with black hair, swing. And he won the youth vote there massively and effectively castrated the two dominant political parties that had existed there for decades, back and forth, like Republican, Democrat. These were competing like socialist type parties. And so Argentina went from the seventh biggest economy in the world back when I was a kid, okay, to almost a backwater third world country in recent decades. It suffered from constant inflation, I mean, massive inflation. Uh, the government there, the prevailing government was intrusive in every way. They had rent controls to try to keep, quote, prices down, but the prices in the rent market were it was choking to people who needed to rent a home. And so it was a real problem in that regard. Food prices going through the roof because the decay in the money unit and so forth. And finally, young people, not old people, but young people who had seen what their parents had gone through for decades said, we're tired of this shit. Get rid of it, something new. And he came into place and said, I want us to get rid of this piecemeal, not overnight. We're not going to destroy government. But he's phased away so many elements of government rule, like rent control. And what's happened to rents over the last year? They've come down, 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 down by absence of government control and certain hygiene methods, whatever else they imposed on the public and on the economy and in other arenas as well. And I know Trump has embraced this guy, but Trump doesn't realize what this guy really is because this guy is not what Trump is. Trump is a big defender of the state, as he's proven since he's been elected. He uses government in various ways, sometimes the same ways that his predecessors did, like wanting to do certain things, therefore I'll make it an order. We'll do it. Okay. Uh, Javier Milei was an interesting example of a country of civilized people that had gone into decay because of continued growth of government. And he said, enough, let's get rid of it. And then just recently, there was a congressional election, not of him, but people supporting him. The question was, would they win and continue to support him? They won even more in the off-year election. The people support him even more because they like this hands in the air. We didn't know what he was going to do. We just know he was going to tear it down, so to speak. Now, that's a micro example, and maybe it won't be replicated, but there are people like him in other parts of the world, including South America. And it wouldn't surprise me if this economic downturn that I think we're going to see, including the doubt that goes with it, will lead in certain countries here, there, maybe even here, who knows? People saying, hey, this Democrat Republican thing just goes back and forth, and yet nothing really changes. I get taxed. My lifestyle doesn't increase. My income can't keep up with the ongoing monetary degradation. And we know Trump wants to degrade further because he wants to print, print, print. He wants money to be free, et cetera. So it's not going to change in that regard. And so maybe there's a point at which, if there's emotion, possibly helped provoked by downturn in the stock market or certain other things, that hands in the air. And so you end up with outcomes you don't expect. You can't anticipate. Hands in the air type outcome. I don't know. I just think there's enough things going on out there right now that could cause that type of wave effect outside of the markets that people aren't anticipating. And it's not necessarily going to be bad. Sometimes when things don't work, hands in the air is a good idea. Start over again. We'll see. So my analysis of markets suggests this is what's going on here. And we're not at the tipping point in terms of causing that pain to be egregious yet. It's getting close. But, I think the downturn in the market will probably be that provoking moment where you can say, okay, there, the clock just began. We'll see.
Sometimes when we hear information like this, it could be overwhelming. And, before we sign off today, how would you like to maybe end this on a positive light? And are there any final words, Michael, that you want to even share with anyone that's watching?
No, I think, reality is reality, okay? And it changes sometimes. Sometimes it changes dramatically because things that have gone before shouldn't have happened. And, reality snaps back and it goes toward it. Usually changes like this are better. You reject something, it might have been better than the thing before, but still isn't working, So man does progress, okay? And so, my book, New Libertarianism, Anarcho-Capitalism, you can go to Amazon and buy it. That philosophically explains what I'm talking about, but it doesn't deal with the specifics of today. It's very broad. But I'm seeing it in the technicals. And again, I don't allow those thoughts to drive my analysis at all in MSA. In fact, I don't talk about this except with you. Okay, I rarely ever talk about this back issues. But the events I see shaping up look like the kind of events that could create many Argentinas around the world, where the old stuff gets in extreme doubt. And it's not just market chaos, it's emotional chaos and sense of what's the right thing to do? What do we need to do that's new? A new coming, as they call, whatever. Okay. Enough said.
Michael, I really want to take this last little bit of time to really thank you. Thank you for everything that you do, not only even on this conversation that we've had today, but how you choose to show up in the world as a heart-based leader. You truly are inspiring, a wealth of wisdom in the financial world, a voice I trust, a voice that I know people like the great Eric Sprotz trust. So, yeah, I would like to just take this last little bit of time to thank you for being here today. And yeah, if there's any final words, now's your final chance.
No, no, our site is olivermsa.com. If you want to subscribe, you tool around on the site. We explain in fair, good depth on our site about our method. What's it all about? How is it different? And if you want some sample copies, you find my picture on the site, and I got my email address below. Just hit it, and or my son Brett, he's there, and request sample reports. Be glad to send them.
And I will totally echo that because I find I get them every week and it's
Yeah.
educated me tremendously and it's given me more and more confidence to be in control of my emotions. So, Michael, thank you for popping that in too. And again, thanks for being here today. Always a pleasure speaking with you.
Thank you, Ben.